Member for Chifley.
Thanks, Acting Deputy Speaker. I rise to speak in relation to the latest report by the House of Reps Economics Committee into the RBA, and I wish to thank the Chair, the new Chair, the Member for Bennelong and the Committee Secretariat, and I note the presence of a number of my colleagues on the committee, notably the Member for Charlton and the Member for Page that are present today, and I understand will be speaking to the report. The report itself, the backdrop to it was the significant move by the RBA to move away from a position that it had stated for some time, in fact since about August of 2013, that it would apply a period of stability to interest rates. It decided all of a sudden in February that it would move away from that period of stability and move to lower interest rates, which obviously raised eyebrows across the community for a host of reasons. When you can look at the economic factors that are in play, you would believe that those economic factors in any other given period of time would be enormously beneficial to an economy. Chiefly, when you look at the drop in oil prices that flowed through to fuel prices, and obviously the CPI flow-through effect of that, you would think that there would be benefit straight away in that avenue, particularly in terms of potentially building consumer confidence and possibly leading to people spending a bit more in the economy and recognising the beneficial impact of that. You would also look at something that has been of great concern to us from an economic perspective for some time, and that is the strength of the Australian dollar. In fact, since the last time it issued its statement, the RBA noted that in terms of the Australian dollar, it had fallen something like 9% relative to the US dollar and about 7% in trade-rated measure against other currencies. And you would imagine that that would be a fairly significant event in itself, and I think off the top of my head the Australian dollar is trading at about around 76 cents, give or take, which is down from the highs well above $1 some time ago. So you'd think those two factors would be enough, but in actual fact what was surprising, and the report carries this quote, when the Governor stated, and I read and I quote into Hansard his comments, "When we reviewed our forecasts in late January, we did not feel that growth thus far had been weaker than we expected 3 or 6 months ago. But when we look forward, as hard as that is to do, we felt that there were fewer signs of a further pickup in non-mining activity than we had hoped to see by now." This is a fairly significant warning about the health of the Australian economy. I mean, what they're saying is they're not just looking at the short term, they're looking down the track as to where they think the economy's headed, and they've made this call to reduce interest rates. Now, the RBA Governor has previously said that words to the effect of you shouldn't see monetary policy as a silver bullet, but at the same time too they recognise there were very few other levers to be able to pull to try and lift growth in the economy. And how are we receiving this type of news by the government? Well, the government has been working flat out, and I'm surprised to hear senior ministerial figures in this government try and tout a number of things as signs of great movement in the economy. Just the other week, listening to some of the stats that were being put forward, the coalition spruiking economic growth is rising. Well, that just flies in the face of what the RBA is saying, that growth in the economy will remain below trend for some time. You hear the coalition spruik the growth in job ads, yet unemployment is higher now than what it was in the GFC, and the RBA is actually concerned, as outlined in this report, about where unemployment will peak, and the fact that the economy isn't growing at a rate enough to see unemployment actually decline. They talk about housing stats, and in actual fact one of the concerns that exist and is touched upon in this report is the growth in investor lending, which I want to come to later, and the fact that that growth is patchy. Other than in Sydney, growth in housing markets is about roughly 5%, and we've put a lot of store in the notion that in the non-mining sector, dwelling activity should be stronger, and it's patchy at best. We've got strong growth in Sydney and Melbourne, and it's not being necessarily replicated elsewhere. The Coalition talks about infrastructure spending, yet the RBA continues to point to the fact that if you're serious about tackling housing affordability, you've got to make sure supply is connected up with infrastructure, particularly transport infrastructure, and this government is making calls on infrastructure that defy the normal, usual process that people can support, which is to have infrastructure decisions, say, for example, through Infrastructure Australia, made independently, made with some rigour, that there's a clear cost-benefit analysis, and it's not happening. What we're seeing in terms of infrastructure spend is basically coalition federal governments working in lockstep with coalition state governments because it suits political priorities rather than the needed infrastructure priorities that are out there. The type of infrastructure priorities that the RBA keeps signalling are important if you want cities to work better, if you want to see productivity respond better, and you want to see the type of concerns that exist about house prices where people will move to areas where they know there's good infrastructure. They will drive up housing prices because of the strength of that demand, and it just makes it harder in terms of the way that the economy and the way that cities work. So the other element that surprises me about the way that the government's going is that they seem to be claiming credit for all these other stats. They can't even get their budget through the parliament, yet they believe that they have been the main driver behind the economy in the stats that they quote. The report also, if I can touch on this, made reference to the work of APRA in developing a suite of macro-prudential tools to address the serious growth in investor lending in the residential real estate market. We've had APRA before us a number of times, and besides this report, APRA actually appeared before the committee last week, giving a bit more insight into its thinking about what it'll do on macro-prudential tools. And I've expressed support previously for Chairman Byers, and I'm particularly impressed by his approach, and I know that the sector is as well, the financial sector is as well, but I'm not entirely sold on an approach that he outlined on dealing with investor lending via macro-prudential tools, where APRA is understandably looking at increased capital requirements on banks because they're losing patience with the bank's response to the growth in investor lending. And you can understand why they'd want to do it. It gives them more bang for their buck. But they're talking about increasing capital requirements at the time where we're looking at increasing capital requirements through the work of Basel III, and we're also looking at the FSI recommendation on cap requirements. And so you can certainly understand why they're going down that path. But the issue that I'm concerned about is transparency, because what APRA is flagging is that when it applies this macro-prudential tool of increased capital requirements on banks, they believe that this will be done behind closed doors. A number of us, regardless of your politics, expressed a mild surprise, I'd put it, on Friday when we were told that this would happen in this way, because we certainly believe that on a public policy issue as big as the growth of investor lending in residential real estate, that this stuff would be done in the open. Now, APRA is saying that they will not require banks to report, that this would not be a reportable matter to the share market, and that this would be done behind closed doors. And it actually flies in the face of the spirit of banking deregulation that's been unveiled in this country over decades now, which was to take away the backroom approach, the cosy approach to the way that mortgage lending was extended and decisions were made on it, and it opens it up, and we're getting rid of those cosy arrangements. But for APRA to now say that, that this would actually be something that's done with individual banks, which I support, you need to do them with individual banks, but to do it behind closed doors, I think raises concerns about transparency. Investor lending growth is a big deal. It grew double the rate of owner-occupier lending in 2014 at about 11%. And applying a regulatory tool of this magnitude in private and not being open to the market about it, not being open to lenders about it, and requiring us to get post-event details through committees or the tabling of reports, I'm yet to be convinced that this is an approach that should be done. We will be testing APRA on this, and I think APRA is going to need to consider a variety of elements in the application of this macro-prudential tool if it is applied. and I look forward to hearing further about the development of their thinking. Obviously, they haven't detailed exactly how they're going to go on this front at this stage, but when they do, I think they're going to need to provide more information to the public about how they intend to proceed.